In this video, we're going to talk about selling options. So this is very much going to be an introduction to what options are, but we're going to focus on selling call and put options. Now, in a previous video, we did a pure introduction to what options are, and we talked about buying options. So buying a call option, buying a put option. So naturally, for me, the next progression was to discuss selling options. So that's what this video is going to be about. We are going to do some review. So we'll talk a little bit about what options are and review call options and put options in terms of buying them. Then we're also going to speak specifically about selling these options. So what I have up on the screen is an article that we are going to reference. You can find a link to that below this video. And then I am going to jump over to a whiteboard when we can maybe run through a few examples to sort of get a better understanding of how these call and put options work. So my name is Tyler Stokes from StokesTrades.com. I'm on a journey to become a full-time day trader, and I'm at the stage now where I am studying options. So I'm going to do this for the next few weeks, maybe even the next month or so. And I'm documenting everything here on this YouTube channel. Now, if you have not downloaded my 6-month blueprint, you can get access to that below this video as well. And that just outlines everything that I'm doing over the first 6 months. So we reviewed a lot of the basics of the stock market. I set up a brokerage account. I got familiar with, buying and selling stock. And now we're on to options. So for me, I've looked into options. I would recommend that, if you're a beginner, you'll probably want to review various sources of information regarding options. Everyone explains it a little bit differently. They are easy to sort of trip up and get confused with. During this video, I'm probably going to kind of stumble a little bit when you kind of think about the different aspects in terms of being a buyer or being a seller. So if you're just learning this stuff, then it's easy to kind of stumble and get tripped up. For me, I needed to review various intros to options many, many times, and I'm still actually going to do that to get an even better understanding. So things are starting to click, but if they don't click for you right away, then just continue to kind of rewatch presentations like this or other presentations to get a better understanding of what options are and how they work. The more you kind of look at this stuff, the more examples and the more videos from various sources, the better your understanding and comprehension is going to be. At least that is what has been happening for me. So we're going to talk really what options are in terms of selling them. I'm not going to talk too much about strategy. For this, we just want to get a fundamental understanding of how these instruments work. So you don't need to buy any courses. There's a lot of great information online, and then it sort of leads you into a course about option strategy. We are nowhere near that in our journey. We just want to learn what these are and how they work. So the biggest difference for me when I was looking at this in terms of buying options and then selling options is this idea of having the right versus having the obligation. So when you buy an option, you have the right, but not the obligation to buy or sell the underlying asset. And for examples, we're going to talk about stock. So when you buy a call option or when you buy a put option, that's a contract that gives you the right to either buy a stock or sell a stock at a strike price, which is the predetermined price. And then it will have an expiration date as well. We're going to review all those terms. But if you flip it and now you become the one who sells the option, which is also referred to as writing or shorting. So now you are the seller. Well, now you have an obligation to buy or sell the underlying asset, which is stocks in this example, if you are assigned up and to and including the expiration date. So I'll cover what assigned means. But basically, if you sell someone a contract, you're obligated to sort of meet the terms that are in that contract if it gets exercised. Whereas if you buy a contract, you just have the right to exercise the contract. You're not obligated to. So that's a big sort of difference between buying and selling. Now, remember, you don't need to own any shares of a stock when you are buying a option regarding that stock or when you're even selling options that are associated with the stock. So if that's the underlying asset in the contract, you don't really need to own any shares yourself. We'll talk about that later. So that's a big a question that a lot of people seem to ask. And then the other thing worth mentioning as we kind of get through this presentation is that typically when you're a trader, you don't really want to own the stock. You're not really interested in that. So for day traders, as we become day traders, we just want to trade the options contract, and as opposed to eventually owning any shares. We just want to trade the contract itself. Now, in the next few videos, we're going to talk about the prices of these options, and then we'll notice how they change when the stock price changes, and then you'll understand a little bit better how you could buy an option and then you can flip it and sell it as the stock price changes, and that's what traders typically do. So if you buy an option, you can sell it at any time, and if you sell an option, you can buy it back and effectively sort of close out your position at any time, and we're going to talk about that as well. So here's just a quick review of some terms associated with options and specifically with buying options. So call options. So that with a call option, the buyer has the right to buy a stock at a predetermined price. So that's the strike price within a set time frame. So if you think of calling, you're sort of calling the stock. You have the right to buy the stock at the predetermined strike price before the expiration date. That is a call option when you buy a call option. Put option, that gives you the right to sell a stock at the predetermined strike price before the expiration date. That is a put option. So when you buy a put option, now the cost of these contracts, so you need to buy these. So if you want the right to buy a stock at a predetermined price, you need to pay for that. And if you want the right to sell a stock at a predetermined price, that's a put, you need to buy these contracts. And when you buy them, the cost is referred to as the premium. And there's also something called the options multiplier. So typically, most options, one option contract represents 100 shares. So the cost, the premium, you will need to multiply it by 100. So if a options contract is listed for maybe $2, that's $2 per share. So you're going to need to multiply that by 100 to find the true cost of that contract. So I mentioned that word assigned. So what does assigned mean? Well, this happens to sellers. Assignment happens to sellers. If a seller is assigned on a call they have sold, they're obligated to deliver or sell the underlying stock. If they are assigned on a put that they have sold, then the seller is obligated to buy the underlying. So why don't we jump to the whiteboard and we'll just go through an example of a call and a put, and then talk about this assigned aspect in terms of the viewpoint from the seller. So we'll look at the viewpoint from the buyer and from the seller just on a whiteboard very quickly here. Okay, so if we want to just look at one example of a call option, and we'll just do this really quick. Let's pretend that the stock price is currently at $100. And we buy a contract with a strike price for $110. And the premium, we'll just pretend, just for example purposes, that this costs us $2. And the expiration date, we'll call it just 1 month, just for easy examples. So if this is a call option, remember, if you're going to buy this, then the stock is currently at $100. Okay, so we'll call it 100, and the stock's trading, and today the stock's at $100. You buy the call option, which means you have the right to sell this stock at $110 within 1 month, and that's going to cost you $2. But remember, it's $2 per share, so there are 100 shares in one contract. So this is going to cost you $200. So why would you do this? Well, if you think that the price of the stock is going to go up and you're bullish on the stock, then you potentially would want to buy this call option. So let's pretend that you are right And within the month, the stock has risen and it's way up and it's now $120. And we'll just pretend that this happened before the 1 month expiration. So as the call buyer now, you have the right to buy this stock at $100, or excuse me, at 110, but it's currently trading for 120. So what you would do, if you want, you could exercise the option and you can buy 100 shares at 110 and you can flip around and sell them immediately for 120 and you would gain $10 per share there. So that's how a call option works. The stock's currently at 100. You buy the option to buy it at 110. The stock goes up and it's 120. You exercise that option. You get to buy it at 110 and it's currently trading on the market at 120. You immediately sell it and you gain $10 per share. So now if we looked at that from the seller's perspective, so if this call option, we are now the one who sold this, then we would basically be looking to sell this option. And what would happen with us is that right away we would get the $200. So if we sold this as the seller, we sold and we would earn right away, we'd get that $200 of premium. But unfortunately for us, the stock has risen and the option has some value now. And at the end of the contract, this person who bought it from us, they want to exercise. So what this means is we are assigned the 100 shares. So at this time, if you sold this call option, at the expiration date, this person exercised, you are assigned, meaning you have to sell your shares at 110. So you as the seller, you're obligated now to deliver or sell shares at 110 because that's the strike price in the contract. So technically, you would lose money. The stock's trading for 120. You have to now sell them to the option holder at 110. So you would incur some sort of loss there. And we'll talk about, what you would do in various scenarios, but that is the perspective of the seller now. You are assigned if this person exercises this contract and wants to buy the stock at 110 and it's currently trading for 120. That is what assignment means in this particular example. So let's jump back over to our article. Okay, so that was an example of being assigned. So if you are a seller, you are obligated if the contract buyer wants to exercise the option. And that's sort of what assignment means. So let's talk more about selling. And you'll notice that with selling call options, you can do something called a covered call or a naked call. And we'll talk about what these are. So a covered call is when you sell a call option on a stock and you actually own the share. So you are quote unquote covered because you own the 100 shares. So if you are assigned and you need to deliver the 100 shares to the option buyer, you can do so. So in that example we just went through on the whiteboard, if you sold that call option and you owned 100 shares, then when the contract is exercised, you don't need to go and buy at 120 and then sell at 110 and sort of lose that difference. You already have the 100 shares in your account and you would just deliver them to that option buyer when they exercise. So that's what's covered. You are covered. You own the shares. If you are assigned and the contract is exercised as the seller, you're obligated to deliver or sell those shares to the contract buyer at that strike price. If you're covered, you already have them in your account and you just send them over to that person. And again, this is all done, seamlessly in your account. But that's what it means to be covered. Now, a naked call involves this exact same scenario, but you don't own those shares. This is slightly riskier because, if that option is exercised and the stock is much higher than that strike price, so even if maybe the stock went up to 150, you're obligated to sell at 110 if you don't own the shares, you need to buy at 150 and then sell at 110. And there's a big loss there. So you're sort of forced to buy the stock and deliver the shares. You have that obligation. So if you're naked and you don't own them in your account, it's riskier because you might need to go out to the market and buy them, and they're much higher in that scenario. So that's a covered call and a naked call. And depending on who presents this information, some people will tell you, only sell calls that you're covered on, whereas other strategies, people might do well with naked calls. But that's just what those two are. So, why would you sell a call option? Again, this kind of leads into a little bit of strategy, but just, all options that you sell, you get that premium. So in that example, we got that $200 right away. That goes right into our account. So, firstly, it's a way to generate income. When you're selling calls or you're selling puts, when you're, selling options, you get that premium right away. But again, that income comes with the obligation to either, buy or sell 100 shares. So as a call seller, you want the stock to remain the same or go down. And this way, the option will expire worthless and it won't be exercised. You simply keep the premium when you received or you sold that option. So let's just quickly jump back to the whiteboard and just view how a call seller makes money if the stock goes down in that example that we just went over. Okay, so here in that example, that call option again, it was a 100 strike and the stock was currently at 100 and the strike price was 110. Okay, and we sold that for $2. So as the call seller, we get that premium right away in our account. It's going to be $2, times 100 shares, because that's how many shares are in one contract. So we get $2. That's our $200. That's our income that we generate when we sell this call option. And it was at 100. And in a month, if the stock, stays the same or goes down a bit, let's pretend it went down to 90. So the stock is down to 90. The person who bought this call option would not exercise it, because why would you have the right to buy the call option at 110 when it's currently trading at 90? You would never do that. The stock option, the call option that you bought gave you the right to buy at 110. The stock has gone down and it's currently at $90. You would never exercise this option. That would make you buy at 110 when the stock is down at 90. So what happens is, after 1 month, this option would expire worthless. You would lose the $200 as the call buyer, but as the call seller, you gain this premium. So for someone who sells a call option, you want the stock to remain the same or go down, because the call option buyer will not exercise this call option. You won't get assigned. You won't have to deliver the shares because that scenario would not work out. The person would never want to do that. Therefore, you just gain the premium. You gain that $200 in this particular example. So that's what happens for a call seller when the stock remains the same or goes down. So let's jump back over to our article. So when you sell that call option, you really have limited reward. The best that you're going to do is that premium, but you do have a lot of risk. So this is why it's recommended. Some people recommend that you don't actually sell a naked call. Again, strategies might involve selling naked calls, but in most cases, or the safer way, is to be covered. You want to already own the 100 shares, and if you don't own the shares, you're naked and you're exposed to more risk. So it's just riskier if you don't own the stock. If the stock price goes up, you're obligated to buy it at a high price and then sell it at the lower strike price. So again, keep in mind that traders are going to have different strategies. You might have someone saying never buy a naked call, whereas some people might have strategies where that works well. So we don't want to get too much into that. But that is a call option. That is selling the call option. Now, on the other hand, you can sell a put, and then instead of discussing a covered or naked, we want to talk about a cash secured put as a sort of example here. So when you sell a put, remember, you're obligated now to buy the shares at the strike price. So if the stock price goes up or remains the same, the option will expire worthless. So it's basically the exact same thing we did with the call, but everything is sort of flipped. So you're no longer going to be obligated if the stock price remains the same or goes up. Now, if the stock price falls below the strike price, you essentially are in a losing position as the call seller. You are obligated to buy the shares at the strike price, even though they are selling for less on the market. So let's talk quickly here why you would sell a put option, and then we'll jump over to the whiteboard and just draw this one out as well, just so you can get a better understanding of this. So it can be risky to sell a put when you don't have the intention of buying these stocks. So this is going to be clear when we run through the example. So if an option is exercised, you as the seller, you're obligated to buy these shares. If you buy the shares at the strike price and you don't want to hold them, you're going to be selling them at the market price, which is lower than the strike price, and therefore you're sort of taking a loss. So it's less risky for you to sell a put option on a stock you will be happy to purchase at the strike price. So you gain the premium and you're assigned to buy the shares. If the option is exercised and you're assigned, then you'll be fine with buying the stock. So if you sell puts on fundamentally strong companies, you will most likely not lose, as their stock price will eventually rise back up. So a cash secured put refers to a put that you sell with the cash on hand to buy the shares if it is exercised. So you have the cash and you're willing to buy the shares at the strike price. If you don't have the cash on hand and you don't have the intention of buying the shares, if the option's exercised, you might need to close out your position, or if the stock's fallen a lot, you'll need to, So before we talk about closing out positions, let's just jump over to the whiteboard and run through this example so we get a little bit of a clearer understanding of buying put, selling put, and then how that would work with exercising or with it expiring worthless. So let's jump over to the whiteboard and just do that quickly. Okay, so let's talk quickly about put options now. So for this example, let's do the same thing. We'll say the stock price is at 100. And for a put option, if you're going to buy it, you are bearish on the stock. So you think the stock is going to go down. So if you buy a put option, you have the right to sell the stock at the strike price within the expiration date. So let's pretend that the strike price here is going to be $90. So $90 is the strike price. And this is $100 is what the stock is currently at. That's the current strike price, the current stock price. And we'll just call the premium, again in this example, just $2. And the expiration is going to be 1 month. Okay, so for this simple example, the stock is currently trading at $100. So what you did if you bought this option is you would have paid $2 times 100, because there's 100 shares in one contract. So you've paid $200. As the buyer, you paid that. And as the person selling this option, they receive this premium. So the buyer gives the seller $200 for this contract. So let's just look at scenario one, where the stock goes down, and within a month, the stock has gone down to 80. So the stock has fallen. So you, as the buyer, you were right. You knew you had your analysis told you that the stock was going down, and it went down, and now it's at $80. So what this means is that you have the right to sell at 90. So you can sell as the option buyer. You can sell at 90, and you can buy at 80 because that's what the market price is. So if you were to exercise this option, what would happen is exercise this option, you would buy at 80. So you'd buy at 80 and you'd sell because you have that right at 90, and you'd be up $10 per share. So if you sold this put option to this person and they exercised the option, what would happen is you would be forced to sell 100 shares at $90. So if you had what we referred to as a cash secured put, that means you have the cash on hand and you're not concerned about buying these shares at 90. So, in real life practices, I'm currently looking to buy some more Tesla stock as the price is going down. So if we did that example, I would be okay with selling a put. I would get the premium. And then if the stock went down, I'm looking to buy the stock at a lower price anyways. In this example, if the stock went down and I was assigned, the option was exercised and I'm forced to buy these shares at 90, I would be okay with that. So if you are an option seller and you sell a put, you have the cash on hand to buy the shares and you're okay with owning the stock now at $90 because it's a good company and the stock price is going to rise back up. So that's a cash secured put, meaning you have the cash to buy the stock price as it goes lower because this person has the right to sell it to you at 90. So that is how a put works for buying and selling. And again, in this example, if the stock did not fall, so if instead the stock at 100, if it went up and it did not go down to 80 and it went up to 110 around expiration time or any time between, this option would never get exercised. So you have the right to sell at 90. You would not buy at 110 and then sell at 90. Therefore, this option contract would expire worthless. And as the seller, you would just keep the $200 premium. So if you sell a put option, you want the stock to remain the same or go higher because the option will expire worthless and you will keep the premium. So that is what you would want as a seller. And again, if you bought this, you would want it to go the other way. You would want the stock to go down because you have the right to sell at 90. It's gone all the way down to 80. You can buy at 80 and sell at 90. Now, if you are the one who sold this put, remember you're obligated to buy those shares at 90. So a cash secured put means you have the cash on hand. And then if you're happy to buy the shares as they go down, if it's a good company and you want to buy them lower, then that's an even better scenario to sell the put option. So let's jump back over and talk about the option of closing out these positions before the expiration date and before you exercise any of these contracts. Okay, so let's talk about closing out your positions early, and then we'll wrap up with a bit of a summary. So when you sell an option, you are essentially, taking on that obligation. When you buy an option, you have the right to buy or sell the stock at the strike price. And then when you sell an option, you are obligated to sell or buy those 100 shares that are in that contract, if the option gets exercised. So in the case of selling a put option, you're agreeing to buy the underlying shares at the strike price if the option is exercised. And when you sell a call option, you're agreeing to sell the underlying shares at the strike price if the option is exercised. So again, that's known as being short the call option or short the put option or writing a put or writing a call. Now, however, you can close out these short positions by buying back the same type of option that you initially sold. So when you sell an option, you don't necessarily need to wait for the option to expire worthless, and you don't need to wait for the option to potentially get exercised. What you can do is you can close out your position. So this is called a buy to close order, BTC. So when you buy back the option, you are effectively, canceling out your obligation to buy or sell the underlying uh, shares. So basically, what would happen is you would sell an option, and then if you wanted to close it out, you would go back and buy the same type of option, not that exact same one, but you'd go to the market and you'd buy, the same strike price, the same expiration date. And then what happens is the new person that sold you that option, they take the obligations that are associated with your original option that you sold. So in other words, by buying back the option, you are no longer responsible for fulfilling the terms of that original contract. So the new seller, the person whom you bought back the option from, now assumes the obligation to buy the shares at the strike price if it is exercised. So that's a buy to close order, and that allows you to effectively cancel your obligations when you're selling these types of options. So for the put option example, if the stock went down below the strike price, you can basically buy back the option that you sold, and you would incur a loss there. So you can do that instead of having to buy the shares as the price has gone lower, which you might not want to do. So if you sell a put option and it's not a cash secured put, and you're not interested in buying the shares, well, as that stock goes down, your put option is getting in the range where it might get exercised. You can actually buy it back and take a loss that way. So when you think about it, when you sell that option for let's say $2, when you want to buy it back, you're going to have to spend more money to buy it back. So you're going to lose money in that regard, but it's a way to close out your position and not have to not have to get assigned those shares that you might not want to. So that's just something to consider with these options. You can close them out early. So let's just move to wrapping up this video, talking briefly about the fact that as a trader, most of the time you don't exercise the option. So it's important to remember in many cases, if you're doing day trading and you're trading these options, you're not going to exercise them. So just some bullet points here. If you can kind of understand these 4 bullet points and sort of walk through all the scenarios, you're on a much better track to really having these options sort of click. And for me personally, I need to go through this a few times. I'm still stumbling on my words a little bit. I'm still saying buy when I should be saying sell. It can be a little bit confusing with all of these different scenarios, buying and selling, and then being the option writer and the option buyer. So it's easy to kind of get tripped up, and I've certainly done it a few times in this video. But again, if you buy an option and it increases in value, you can sell the option. So you can trade the option. If you buy an option and it goes the other way on you, it decreases in value, you can sort of sell or close out your position before it expires worthless and just take a little bit less of a loss. You can do that. If you sell an option and the trade goes your way, you simply keep the premium. So if you sell an option, you get that premium, and it goes your way, it expires worthless, you will keep that premium. If you sell an option and it goes against you, it decreases in value in terms of your position, you can sort of buy it back without it getting exercised, without you having the shares assigned to you. You can close out that position at a loss as well. So again, most traders, they trade these options rather than exercising them or letting them get assigned these shares. So if you can kind of run through those scenarios, you will certainly be in a better position. And again, it might take a few times and a few videos to sort of get to that position. So what I have here is, lastly, we'll just run through again from the call perspective, how you profit and how you might lose with call options, and then how you might profit or how you might lose with put options. So a little bit of a summary here, and then we'll wrap up this video. So again, if you buy a call option and the stock goes up, you can sell that option for a gain. So you profit when the stock goes up. So again, in that scenario that we did, we bought a call option with a strike price of $110. If the stock goes up to 120, well, that option has now increased in value, and we can actually sell that option. So in the next video, we're going to talk about, what affects the price of the option. But for now, just know that, in that scenario, the option has, increased in value. So we can basically just sell the option for a profit, or you can exercise the option. So you have the right to buy at 110, and the stock's currently trading at 120. Well, you buy at 110 and you sell at 120 and you gain a profit. So you can profit from call options when you buy them when this stock goes up, and you can exercise your option, or you can just trade the option itself because it has increased in value. So that's a call option with the stock going up. Now, if the stock remains the same or goes down, basically the option will expire worthless, and the most that you're going to lose is the premium that you paid for that option. You can also sell the option before it expires to sort of incur sometimes a smaller loss. So that's what happens from call options when you buy them. Now, if you are the one who wrote the call option, so you're selling the call option and the price remains the same or goes down, that's good for you. The option will expire worthless and you basically just keep the premium. Now, if the stock goes up and you wrote the call option, so you sold the call option and the stock goes up, well, what happens then is that the option might get exercised. So if it does get exercised, again, you're obligated as the seller to sell 100 shares of that particular stock. So remember, the call buyer has the right to buy at the strike price. You're the call seller, so you need to sell your shares at that strike price. Now, if you own the 100 shares, that's a covered call, and you can basically just deliver those 100 shares. If you don't own those 100 shares, then that's a naked call. You're selling a naked call, and you would have to go out and buy the shares at 120 and then sell them at 110, and you're going to incur that loss. Now, what you could also do before the option is exercised, you can buy it back for a higher price and basically close out your position, but you will incur a loss. So you sold it and you got that premium, but the option's value went up. So if you want to close out your position, you would have to buy it back at a higher price and you'd lose on there. So you can lose basically from having to sell the shares, or you can lose from closing out your position at a little bit of a loss. So that is how a call option works for buying and selling these call options. And again, the price we're going to talk about in the next few videos because that's important to understand what happens to that price of that option when the stock either goes up or goes down. So again, just a summary here for a put option. Everything now is sort of flipped. So when you buy a put option and the price of the stock goes down, the value of that option contract that you have goes up. So you can sell the option for a profit. So again, if you bought a put option for a strike price of 90 and the stock's at 100 and the stock goes all the way down to 80, well, you have the right to sell at 90, but the stock is at 80. So what happens? You buy at 80 and you sell at 90 and you get that profit. So you can exercise that option and actually do that if you want, but most traders are just going to trade that option. So you bought the put option, the stock's gone down, your put option has increased in value, therefore you sell it back at the market and you get a profit. Now, if the stock remains the same or goes up, basically your put option is going to expire worthless, and the most that you're going to lose is the premium that you paid. And again, you can close out your position before it expires as well. Now, if you sell a put option, so you're writing the put option or you're shorting the put option, right away, you're going to receive a premium right away. As soon as you sell it, you're the seller of that contract. So you are obligated to buy the 100 shares. So if in this example, if you sell it and the stock remains the same or goes up, basically that option is going to expire worthless and you just keep the premium. Now, if the stock goes down, so you've sold a put option and the stock goes down, the value of that option will go up. So if you'd like to close out your position because you don't want to buy 100 shares of that particular stock, then you're going to have to buy it at a higher price than you sold it for, and you're going to basically have to incur that loss. If it's a cash secured put, then as the price goes down and you are assigned those shares, you have to buy at the strike price. If you have the money on hand, that's a cash secured put, you buy the 100 shares. And if it's a company that you are okay with owning those shares, then you just buy them low and sort of wait for the stock to come back and rise back up. So that's the scenarios of how you make money or how you lose money with buying or selling a put option. So that's it for this video. I hope that you found this useful. Again, I repeated myself quite a few times about the importance of just watching these types of videos over and over. Personally, I've had to watch these type of intro videos several times from several different sources, and I'm still going to review them just so this all clicks in for me. And again, I've stumbled on my words a few times in this presentation. You're going to kind of get tripped up also, but if you can kind of run through these in your head, or if you can draw these out, or if you can explain them to someone else, I think that's really going to help you sort of understand how these options really work. So in the next video, what I thought we'd do for our option series, the next sort of logical step for me in my learning is now to review some of the prices of these options, how they change, and sort of what happens to the option in that regard. So that's going to be the next thing that we do. Subscribe to this YouTube channel to stay up to date. And again, if you've not downloaded my 6-month blueprint that outlines all the things that I'm doing in the first 6 months of this journey to become a full-time day trader, you can find a link to that below this video. So thanks so much for watching, and I will see you in the next one.